Right now, while you're watching this video, your money is doing absolutely nothing. It's just sitting there in your bank account, collecting dust and maybe 1% interest if you're lucky. Meanwhile, inflation is out here acting like Pac-Man, eating 3 to 4% of your purchasing power every single year. Do the math, you're literally getting poorer by doing nothing. But here's what nobody tells you. Investing in the stock market isn't gambling. It's the only realistic way regular people build actual wealth. I'm not talking about becoming a millionaire overnight. I'm talking about not eating instant ramen when you're old and retired. In this video, I'm going to show you exactly how the stock market works, where to invest, and the real numbers behind compound interest that'll make you wish you started yesterday. And here's the kicker. At the 5-minute mark, I'll reveal the one decision that could cost you literally millions of dollars, so don't click away. Let's start with the absolute basics because you can't invest in something you don't understand. What is a stock? Imagine Apple, worth about $3 trillion, decides to cut itself into 15 billion tiny pieces. Each piece is called a share or stock. When you buy one share for, say, $180, you're literally buying a microscopic piece of Apple. Congratulations, you now own part of the company that convinced you to spend $1,200 on a phone every 2 years. Here's why this matters. When Apple makes more money, your share becomes worth more. When they mess up, remember the butterfly keyboard? Your share drops. Your wealth is now tied to the company's success. That's the whole game. Now, let's talk about common versus preferred very quickly. Let's start with common stock. This is what 99% of people buy. You can vote on company stuff, cute but meaningless unless you're a billionaire and own a lot of shares, unlimited growth potential. If it moons, you moon. You get paid dividends, or money sometimes. Preferred stock. There are no voting rights, but there is fixed dividends, so you get paid first. It's way less exciting, but more stable. For beginners, stick with common stock. We're here for growth. Now, where do you actually buy these? We buy these at the stock exchange. It's like eBay, but for companies. The main ones you need to know are the New York Stock Exchange, the OG, home to companies like Disney, Coca-Cola, Walmart. NASDAQ is the tech bro of stock exchanges, houses Apple, Nvidia, Tesla, Microsoft. Other global exchanges are London, Tokyo, Hong Kong because money never sleeps. Pay attention to trading hours. This is important. For the US markets, it's from 9:30 a.m. to 4 p.m. Pre-market or after hours exists, but this is way riskier. Imagine shopping at a store at 3 a.m. Prices are weird. And here are the trading hours for other major stock exchanges. Now, here's something most beginners don't realize until it's too late. Let's look at real examples because theory is boring and we're not in school anymore. Example 1, Tesla. In January 2020, $29.93 per share, split adjusted. In January 2021, $163.04 per share. That's a 445% return in 1 year. If you invested $1,000 in January 2020, you'd have $5,450 by January 2021. That's enough for a really nice vacation or, more Tesla stock. But here's the reality check by January 2023. Tesla dropped to around $113. That's why we don't put all our eggs in one basket, no matter how much we love electric cars and flamethrowers. Example 2, S&P 500. Now let's look at something less exciting but way more reliable. The S&P 500. This is an index of the 500 largest U.S. companies. It's like buying a tiny piece of the entire U.S. economy. 10-year average return is about 10 to 12% annually. 2020 to 2025 performance. Despite market crashes and whatever drama was happening, it recovered and grew. If you invested $10,000 in an S&P 500 index fund in 2015, you'd have around $25,000 to $27,000 by 2025. Not as sexy as Tesla, but you also didn't have to stress about Elon's tweets. I will show you more of what this actually looks like with real money and real companies, including the AI stocks that are literally reshaping our world right now. Let's talk about NVIDIA, the AI gold rush company. In January 2019, each share was effectively $3.41. That's cheaper than a meal deal. You could have owned a piece of the future for the price of a chapstick. In January 2023, we're at $14.31. People thought they missed the boat then. Spoiler, the boat was actually a rocket ship. Today, February 9th, 2026, we are sitting at $185.41. Let's do the what-if math. Imagine it's January 2019. You have $5,000. Instead of spending it on a used Honda Civic that smells like old gym socks, you put it all into NVIDIA. Your total return? 5,337%, because they make the chips that power AI, and AI is basically eating the world. Right now, ChatGPT to self-driving cars to literally everything. That's not a typo. That $5,000 would be worth $271,862 today. You didn't just buy a car, you bought a $250,000 house paid in full with enough left over to buy the gym socks you originally smelled. But look, not everybody has the stomach for that kind of roller coaster ride. So let's be real and compare the different strategies side by side. Strategy number 1 is what most people think of when they say investing, picking individual hot stocks and swinging for the fences. Take NVIDIA. Over the last 7 years, it's up a mind-blowing 2,268%. That's the kind of return that turns heads and makes millionaires. Tesla? Absolutely insane in 2020 and 2021, up over 1,500% in basically 2 years. But then 2022 and 2023 hit, and it got crushed more than 50%. That's the definition of volatile as hell. 1 minute you're a genius, the next minute you're checking your portfolio in the bathroom stall because you can't sleep. Even something safer like Apple, up 520% over the last 10 years. But notice how much slower and steadier that ride has been compared to the rocket ships. Now, strategy number 2. I call this the I actually have a life strategy. Just buying an S&P 500 index fund and chilling. Over the same 10-year stretch, the S&P 500 is up about 180%, which works out to roughly 10 to 12% per year on average. That's not going to get you on any Forbes cover. But here's the thing. You instantly own a piece of 500 of the biggest, best companies in America. No stock picking, no timing the market, no panic selling when Elon tweets something crazy. Way less stress and still absolutely life-changing returns if you just leave it alone. So yeah, you can chase the NVIDIA 22 baggers and ride the Tesla roller coaster if that's your personality. Or you can buy the boring index fund, go touch grass, and still end up seriously wealthy. Both work. The question is, which one lets you sleep at night? Here's a real-world scenario. Your friend Sarah invested $10,000 in an S&P 500 index fund in 2015. She literally did nothing, just left it there. By 2025, it's worth $26,000. That's $16,000 in profit for doing absolutely nothing except having patience. Meanwhile, your other friend Dave tried to day trade crypto and individual stocks. He's down $3,000 and has stress-induced hair loss. Now you're probably thinking, okay, cool numbers, but why should I even bother investing when I could just save my money? That's exactly what I used to think too, until I learned about the silent killer that's robbing you every single day. That is inflation. This silent killer is why your grandparents could buy a house for $20,000 and now you can barely afford the down payment. Here's the uncomfortable truth. Saving money is actually losing money. Let me show you the math. Guys, I need you to understand something that will change your life forever. If you just leave your money in the bank, you are quietly losing money every single year. Let me prove it with $10,000 right now. Scenario 1, you put it in a normal savings account. After 1 year, the bank gives you maybe 1% interest. You now have $10,100, but prices went up 3.5% because of inflation. So your $10,100 only buys what $9,750 bought last year. You just lost $250 of real money. And you didn't even touch it. Scenario 2. You put the same $10,000 in the stock market, S&P 500 index fund, and it grows the historical average of 10%. After 1 year, you now have $11,000. After inflation, that $11,000 still buys $10,630 worth of stuff from last year. You just made over $630 instead of losing $250. That's almost $900 difference in just 12 months, doing nothing different. Now, fast forward 10 years and let the math do its magic. If you leave it in the bank, your $10,000 shrinks to only about $7,000 in today's money. You're 30% poorer and you didn't even spend it. If you put it in the stock market and just leave it alone, that same $10,000 grows to nearly $20,000 in today's money. Same 10 years, zero extra effort. One choice, slowly get poorer. The other choice, quietly get rich. This is why rich people don't keep money sitting in the bank, and now you know too. So please, stop saving your way to being broke. Start investing, even if it's just $50 a month. This is why investing isn't optional if you want to. Retire before you're 80. Buy a house, travel, literally do anything except work until you die. But here's where it gets really interesting. And this is that million-dollar decision I mentioned earlier. Albert Einstein called compound interest the eighth wonder of the world, and he wasn't kidding. It's simple. You earn returns on your returns. Money, makes more money. Watch this. Person A starts at age 25, invests $500 per month. 10% average annual return. By age 65, $3,162,040. Total invested, $240,000. Compound interest earned, $2,922,040. Person B starts at age 35, just 10 years later. Same $500 per month, same 10% return. By age 65, $1,139,664. Total invested, $180,000. Compound interest earned, $959,664. That's $2 million lost by procrastinating for just 10 years. That's the cost of saying, I'll start next year. That's the difference between retiring in a beach house and working at Walmart as a greeter because you can't afford not to. Quick trick, the rule of 72. Want to know how long until your money doubles? 72 divided by your return rate equals years to double. For a 10% return, it's 7.2 years to double. Your $10,000 becomes $20,000, then $40,000, then $80,000, then $160,000. Time is literally money. The longer you wait, the more you lose. Forever. Okay, so you're convinced. You want to invest. But now you're wondering, what about taxes? And more importantly, what should you actually buy? Let me give you the exact blueprint. Here's your beginner investment blueprint, ranked from start here to maybe later. Tier 1, index funds and ETFs, ideally 70% of your portfolio. 1. VOO or SPY. These have the top 500 U.S. companies in one fund. 0.03% fees, almost free. Historical 10 to 12% annual returns. This should be your bread and butter. 2. QQQ includes all the tech-heavy stocks like Apple, Microsoft, Nvidia, Tesla. Higher risk, higher reward potential. Captures the tech and AI boom. 3. Vanguard, total stock market, VTI, literally holds every U.S. public company. provides maximum diversification. 4. Vanguard Total World Stock VT provides exposure to global stock markets. The true set it and forget it. Tier 2, blue chip stocks. These are stable and reliable, ideally 20% of your portfolio. These are individual companies that aren't going anywhere. Apple, ecosystem king. Microsoft, cloud, AI, Windows forever. Nvidia, AI, chip monopoly. Alphabet, Google, search plus AI plus YouTube. Amazon, e-commerce plus AWS cloud. Visa, every transaction equals profit. Where to trade? Fidelity, Charles Schwab, best for U.S. investors, great research, interactive brokers, allows global access and low fees. Futu, Moomoo, these are popular in Asia with easy interface. Robinhood, simple, clean, easy to use but has limited features. The tax talk. I'll make this quick. Yes, Uncle Sam or your government wants a cut. This is called capital gains tax. If you hold less than 1 year, this is considered short-term and is taxed as regular income, up to 37% U.S. If you hold more than 1 year, meaning long-term, this is taxed way lower, around 0 to 20% U.S. Here's a table if you want to know more. What not to buy as a beginner. Penny stocks, anything under $5. Options trading, unless you like losing money fast. Individual stocks based on Reddit hype. Anything promising, guaranteed returns. Meme coins and sketchy crypto. Start boring, get rich slowly. That's the actual secret. All right, we've covered a lot, but before you close this video and actually do nothing, which is what 90% of people do, let me give you the exact action plan to start today. Step 1. Open a brokerage account. Takes 15 minutes. Pick one. Fidelity, Schwab, Interactive Brokers. Link your bank account. Done. Step 2, start with $500 to $1,000 or whatever you can afford. Don't invest money you need for rent. This is long-term money you won't touch for 5+ years. Step 3, buy an index fund. Literally just buy VOO or SPY. That's it for month 1. Step 4, set up automatic monthly investments. $100, $500, $1,000, whatever fits your budget. Dollar cost averaging equals investing the same amount regularly. You buy low sometimes, high sometimes, but it averages out. Step 5, don't touch it. Don't check it every day. Seriously, you'll stress. Don't panic sell when it drops. It will drop sometimes. The final truth. Investing isn't about being smart. It's about being consistent and patient. If this video finally made investing click for you, hit that like button. If it didn't, still hit that like button. Subscribe for more real finance advice without the BS. And comment invested. I want to see it. Now go make some money. I'll see you in the next one.